Cathie Wood's views on Tesla's stock. Star investor Cathie Wood has consistently been a strong proponent of Tesla. Her predictions about Tesla's stock are closely watched by many. Cathie Wood, known for investing in companies engaging in disruptive innovation, made millions during Tesla's surge in the early days of the pandemic. However, a brutal 2022 sell-off wiped away many of ARK's gains. Currently, ARK owns about $487 million worth of Tesla, making it the firm's fifth largest holding. Most of these shares are in its signature ETF, which added more than 300,000 Tesla shares to its portfolio over the last month. Despite an unfavorable macroeconomic environment and elevated interest rates dragging down the market, Tesla's decline largely coincided with Elon Musk's purchase of Twitter. Musk dedicated much of his time and financial resources to the social media company, which did not sit well with Wall Street. During this downturn, Wood has remained bullish. Last month, she predicted Tesla shares would reach $1,500 by 2027, representing a more than tenfold increase. Despite Tesla facing numerous issues today, Wood said the stock has a long way to go and could rise significantly in the next 5 years. In a Barron's interview, she mentioned that although some people don't buy Tesla's cars now, price cuts on the models could change that. If Tesla can lower costs as expected, she believes many people will be guided by economics rather than the naysayers around Twitter. Wood cites 3 sources for the expected increase in Tesla's price target. The first is the emergence of competitors, often referred to as Tesla killers, in the market. Due to this, Wood and her firm ARK Invest expect Tesla's market share to decrease. Globally, including China, Tesla's market share in electric vehicles has risen to 18%. Wood attributes this to Tesla being far ahead of competitors like BMW and Mercedes in terms of range and other critical metrics for electric vehicles. She also highlighted that Tesla's battery costs are 3 to 4 years ahead of any other auto manufacturer in terms of cost declines. This means that to compete with Tesla, other auto manufacturers would need to sell their cars at a loss, especially while losing market share in the internal combustion engine sector. Wood explained that most other auto manufacturers would struggle to match Tesla's combination of performance and range unless they are willing to incur losses. When asked about her thoughts on Tesla in 5 years, Wood believes that Tesla's significant lead in key areas will continue to set it apart from competitors. Cathie Wood believes that compared to other auto manufacturers, Tesla has a significant edge. She mentioned that when analyzing cars based on range and power combination rather than brand, Tesla stands out as the top pick. Although brands like Volkswagen and BMW have made significant strides in recent years, Tesla remains far ahead in terms of range and power. Wood emphasized that most other auto manufacturers will struggle to match Tesla's performance and range unless they are willing to sell their cars at a loss. She highlighted that this gap is crucial from both a performance and range perspective. When asked about large corporations competing with Tesla in electric vehicle production, Wood stated that they are failing miserably. She acknowledged that other manufacturers have strong brands and loyal customers, but as consumers transition from gas-powered to electric vehicles, they will increasingly focus on specifications. According to Wood, while brand loyalty might still influence some consumers, these brands won't be able to offer electric vehicles that match Tesla's capabilities. In a January 7th tweet, Cathie Wood highlighted the enormous opportunity in the EV market. She responded to a tweet by ARK Invest's Director of Research for Autonomous Technology and Robotics, Sam Corris, who mentioned that Tesla's superior margins, drivetrain efficiency, and low battery costs position it well to weather any cyclical downturn in the auto industry. Corris noted that Tesla could be the first to lower prices, putting pressure on other automakers. Wood added that according to ARK's CFA Tasha Keeney, Sam Corris, and ARK's research, Tesla does not need autonomous ride-hailing to be successful. She reiterated that Tesla's EV opportunity alone is enormous. Presenting ARK's research, Tasha Keeney stated in a tweet that even without autonomous driving or ride-hailing, Tesla's prospects are strong. Cathie Wood predicts that Tesla's EV opportunity alone could result in significant gains over the next 5 years. According to ARK Invest's updated open-source Tesla valuation model, published in mid-April, the expected value per share is $4,600 by 2026. This was calculated before Tesla's 3-for-1 stock split in August. Post-split, the 2026 price target would be roughly $500 per share, which represents more than a fourfold increase from the current price. Wood remains highly bullish on Tesla and sees the stock increasing fivefold within 5 years. ARK Invest continues to heavily invest in Tesla, making it the third largest holding in ARK Innovation ETF, behind Exact Sciences and Zoom Video. After several buys in January, Wood's ARK funds purchased 49,983 Tesla shares on January 18th, valued at $6.4 million at that day's close. In total, ARK absorbed 806,663 Tesla shares in January alone, valued at $103.9 million as of January 18th. Despite Tesla shares plunging 58% over the last year due to concerns about production and demand, Wood foresees substantial gains ahead. She believes the stock could almost increase fivefold in the next 5 years based solely on its electric vehicle business. ARK's research suggests that autonomous ride-hailing, which they estimate will be more than 60% of Tesla's value over the next 5 years, isn't necessary for Tesla to succeed. In a webinar cited by CNBC, Cathie Wood stated, "If you believe in autonomous cars at all, it's closer to 13 times during the next 5 years." This means she is as bullish about Tesla as ever. According to her, 5 times the recent price would be $653, and 13 times would be $1,699. Wood believes Tesla's strategy of implementing significant global price cuts is smart. Tesla is going to be very aggressive in pricing, she said. Tesla can afford to do this. It has the lowest cost structure and is innovating the most aggressively. Other auto manufacturers will have to follow these price declines, but it will hurt them from a margin and profitability point of view quite significantly. Despite her optimism, there are still considerable concerns about Elon Musk's involvement with Twitter. Dan Ives, a Wedbush analyst and vocal Musk critic, told Yahoo Finance, "Musk set off this 5-alarm fire on Tesla stock, and he's the only one that can extinguish it. It's a perfect storm between the Musk-Twitter fiasco and now demand cracking." During a recent testimony in a Tesla shareholder lawsuit, Musk argued that it was absurd to suggest his tweets could impact Tesla's stock price. He pointed to an example where Tesla's stock price rose after he tweeted that he believed the stock was too high, indicating that his tweets do not necessarily influence stock prices. Musk stated, "Just because I tweet something does not mean people will believe it or act accordingly," and he saw no causal link between his tweets and Tesla's stock price. Overall, ARK's 2026 price target for Tesla stock is around $500 per share, more than 4 times its current valuation, based solely on its EV business. This projection, adjusted for the 3-for-1 stock split effective on August 25, 2022, adds context to the pre-split price target of $4,600 announced in mid-April 2022. ARK analyst Tasha Keeney noted that the firm is excluding autonomous driving and ride-hailing from the valuation framework. Despite this, ARK believes these two factors will drive more than 60% of Tesla's value over the next 5 years. Keeney emphasized that the $500 per share projection represents more than a fourfold increase from the stock's current levels. Subscribe to this channel for more Tesla stock predictions.